Howdy, folks. Welcome to the Daily Coin. My name is Rory, and today is Wednesday, June the 7th, 2017, and I have the very distinct honor and great pleasure of welcoming back to the show Mr. Turd Ferguson, a.k.a. Craig Hemke from the TF Metals Report. Craig, how's it going today?
Rory, you're very kind in calling it a distinct honor or whatever it was you said. I don't know if anybody else feels that way, but it's always a pleasure to visit with you, my friend. So thanks for the invite.
Well, I'm glad that you're here. And just before we started recording, I was explaining to you how I felt about your interview that you just recently did with Max Kaiser, which was really one of the best that I've seen him do in quite some time. And it was really very engaging and really well done. And if you haven't seen it, you need to. It's in two parts, well worth your time. And that sparked a couple of questions from me, Craig. And the first one is the yen carry trade, or the yen gold, how those two line up as far as the way that gold is manipulated, and it follows. You've explained endlessly how they follow tick for tick. And I was watching CNBC yesterday, and they had the yen up there, and it said that it had gained, or that it was down 1.09%. And I was thinking, okay, I'm going to see what gold is. And I was thinking gold's going to be somewhere between 0.108 and 1.10% up. And sure enough, 1.10% up is exactly what it was. And what I want to ask, Craig, is the Chinese have a direct currency swap with Japan. What role does that play as far as this yen gold manipulation that you've been able to identify and prove that they follow one another? Does that mean that the Chinese are in on this, or how does that affect the yuan? What is the yuan's role in this, if any? I mean, it just seems like there's something that it has to be affected somehow, or am I just out wandering around in the weeds with that?
Well, I think first and foremost, we're all kind of wandering in the weeds because we're all attempting to explain, rationalize, come up with, some explanation for how and why this is occurring. Because what you cannot deny is the fact that it is occurring. You can actually go back. I've been writing about it at TF Metals Report for almost 3 years. I think, for what it's worth, I was probably about the first person to notice it, and I stumbled on it because you can't take the way that the dollar yen is traditionally quoted, the USD JPY. You can't plot that with gold and see anything other than an inverse correlation. And so a lot of people miss it. What you have to do is you have to invert that traditional quote into a JPY USD and then plot it with gold. And then you see the day-to-day, hour-by-hour, almost tick for tick on a nanosecond level correlation. The correlation began, and this is what's interesting, about 2008. That's when all of a sudden they began moving in tandem, and it has been almost one for one since about 2012. And people should sit back and go, 2012, what happened in 2012? That was when QE3 started, and that was when gold inexplicably, into the shock of everybody, went from 1,800 to 1,200 while QE3 was going on, right?
Yep.
So what's undeniable is the fact that this correlation is there. And so we're all left trying to figure out why and how it began. At its core, it's obviously a computer program because things don't move, like I said, on almost a nanosecond, intrasecond level by humans. I mean, humans don't see, oh, look at the dollar yen, I better put in a sell order for 100. No, it's all tied by HFT, just like all markets are now almost totally dominated by high frequency trading computers. Very little carbon-based trading going on at this point. And so we're all left trying to, again, come up with a rationale. Your idea that maybe it's something to do with the yuan and the yen and Chinese demand and all that kind of stuff, sure, I think that should be looked into. We've often speculated as to whether the key manipulator was actually China, trying to keep paper prices down while they're accumulating the physical itself. Again, that's a theory that deserves to be looked into. There are a lot of folks out there that don't want to see this correlation, that want to write it off as, well, with that traditional "I'm smarter than everybody else," correlation is not causation, argument. Like somehow you've got a PhD in this kind of stuff, and so therefore we're all to be marginalized. Whatever. Folks have a lot of traditional analysts that have their beaks dipped in they get their bread and butter by analyzing gold and the gold market in a traditional sense, the way we analyzed it 20 years ago, even 7 or 8 years ago. Supply, demand, and whether it's global supply and what are the Chinese and the Indians doing and all this kind of jazz and Elliott wave and look, man, none of it matters anymore. Maybe at the fringe it matters, but this notion that somehow physical supply and demand has really anything to do with the intraday price, no, it's the movements of the yen, and that's why we've all, at least on my side, I've become almost a foreign currency analyst. If we can predict where the yen is going, we can predict where gold is going. We've had pretty good success with that as of late. Anyway, putting this back to your question, your theory is valid. Let me, if you don't mind, I'll try to sum this up in about 90 seconds as to what my working theory at this point is. Is that okay?
Fine. Go for it.
If you go back to 2011, the banks that make markets in these paper markets, okay, whether it's paper gold or paper silver, it's the banks that are always the shorts, right? Nobody's going to argue that. You get that in the COT data. I mean, it's the commercials versus the specs. The commercials are always short. The specs are always long, net on a net basis. So these commercials, these banks, are the ones that create the contracts. The 60,000 new gold contracts in the last week have been created by the banks, fed to the specs buy them. Well, these banks are taking a rather significant risk, wouldn't you say, right? In this
I would.
Heavily leveraged system by being short. Now, back in 2011, these banks had almost an extinction level event put on their doorstep, specifically in silver, specifically JP Morgan in silver. Because if you recall, back in the day, JP Morgan was assumed to be the big short, and JP Morgan didn't have any silver. And it was only after the epic commercial short squeeze that ultimately took price that last $10 up that we got the 5 rate hikes, margin hikes in 9 days. We got the Sunday night smash. We got all that kind of stuff. Oh, and then in the couple of weeks after, JP Morgan is suddenly granted the license to open a COMEX vault in silver. Imagine that.
Yep.
And now they've gone from 0 ounces of silver and no vault on the COMEX to now having 54% of the silver on the COMEX and 110 million ounces. So they were faced by having this short position. They were getting squeezed. And that's what 2011, especially at least the end part of 2011, that run-up was all about, was a near signal failure, as they call it, commercial short squeeze, potential extinction type almost event. And the same thing is true now still for gold. These banks are short 500 tons, 600 tons of COMEX on the COMEX alone, right? And they're taking that great risk. And so I think, I promise you a 90-second answer. What are we, about 3 minutes into this?
It's all good.
Okay. As that is a background, now here comes what I think is happening. I think the banks have assessed that risk of making this market. Let's give them just nothing, as Blythe Masters even said, oh, we don't take directional bets. We're just, we're altruistic. We're just making a market, all this kind of stuff. Let's take that perhaps at some level of face value and truth. And let's just say that, yeah, these banks are simply trying to make a market. Of course, they're profiting handsomely doing it. They're taking this massive risk by being short. Well, okay, if you're a bank, then what you need to do, any type of bank, trading desk, any big trader, they do this thing called delta hedging, where they try to eliminate as much risk as possible from some underlying position. Okay, so if your underlying position is short all of this paper metal, well, then you've got to delta hedge. You've got to try to spread off that risk as much as you can of being short. And that's it was that being short that almost killed them in silver in 2011 and also in gold by September of 2011. So these banks are trying to hedge these massive positions. Okay. The problem is, it's particularly in silver, but in gold too. These are not the biggest markets in the world. Gold's a pretty big market, but again, it's not the size of foreign exchange. It's not the size. And what do they trade in dollar volume in the foreign exchange markets every day? $5 or $6 trillion.
Yes.
Right. So here's what the banks have done. At least this is my working theory. I think the banks designed these HFT programs. And I think the banks have put them in place that have, for all intents and purposes, linked at the hip on a one-to-one basis the price of paper gold with the dollar yen. For the purposes of, if you can turn gold into the yen, basically, right?
Okay.
I mean, the gold now, if it moves the same as the dollar yen, they're basically the same thing.
Right.
Well, now you can hedge your gold, which is kind of a smaller possible pool for hedging, in this much larger and much more depth Forex dollar yen pool. And you can do it without really anybody knowing it. And so that's what I think is going on, Roy. I think that's, to me, at least, that's the most logical thing that I can put my arms around for explaining the correlation at this point, is that the banks themselves have put these dominating programs into place. And they've done so that they can delta hedge, as they call it, this great risk that they're taking by being short. And now they can hedge off their gold risk by hedging in this much deeper, broader pool of dollar yen derivatives and options and everything else, and minimize the risk. That's why it's done. That's what I'm thinking. That's why it's there. Anyway, like I said, I could be dead wrong. We don't know. No one can say for certain why it's there. We just know that it is.
Well, it makes perfect sense to me. You've got to have a counter bet. You're going to lose money on one side, potentially lose money on one side. So that's why you have a hedge in the first place, is
right,
to counteract that loss.
And what we can't get away from, and again, you can see it yesterday, as you pointed out. You can see it since the first of the year. You can see it all through last year. Go on and on. If you want the price of paper gold to go up, then you want the dollar yen to go down, or that yen dollar to go up, however you want to state it.
However you want to play it.
Yep.
Well, what are your thoughts on this 50% increase in gold moving into China? I mean, that is massive. I mean, there are people saying that it's, a doomsday hedge or whatever. I think they're just buying because they don't have anything else to put their money into, because everything else is junk or going to junk.
Right. And for whatever reason, whether they're eventually, converting dollars into hard assets, dollar reserves into gold reserves, whatever. I mean, all these different things are going on. And at the end of the day, I poo-poo the physical demand in China and India and everything is to not having an impact on a daily basis or an intraday basis. But at the end of the day, this is the only thing that's going to finally end this system. Because there are a lot of people who are listening to that last answer that said, well, hell, this will never end, right?
Right.
Dollar yen will just fluctuate and gold will fluctuate with it, and the banks will manage the flow of the physical metal at the price, and we'll just be range bound forever unless the yen just soars and the dollar collapses. Conceivably, yes. But what will break this system is that what everybody has to remember is the system is ultimately based upon physical metal. Now, it's hyper leveraged. I mean, there may be 100 claims for every physical ounce in the West, right? Through unallocated accounts and, GLD and all this other stuff. But it is physical metal that backs up this scheme, the scam of the paper derivative pricing. And so as metal is removed from the West, it does stress the system. Like I said, the banks try to manage all of this. They can maybe hedge away some of the risk of being short through this dollar yen connection, but still they're still the ones, the bullion banks are the ones, those are the parties that are responsible for flowing metal at the wholesale level at these prices. And so as physical metal gets harder and harder to come by, more and more scarce, it just makes their challenge more difficult. Then you throw on too, Roy, that squeeze, you throw on this, all of this pending lawsuits and litigation and civil class action stuff. And it frankly just becomes not a profitable venture for the banks to be messing with.
Right.
I mean, when they can do all this riskless stuff, borrow from the Fed at what 1% now, and then go buy bonds at 2 or 3, why are they even dicking around with the metals? I know it's profitable, but at some point it becomes not worth the trouble. And so the physical demand, all this other stuff, is all playing a key role to eventually ending it. That the hard part is that this system continues until we get to that point, and nobody knows when that we're actually going to finally get to that point.
Well, and seeing that ties right back to my original question as far as trying to figure out the Chinese role and this direct currency swap, because it seems like that once again the Chinese would be in complete control, because if they have a direct currency swap between the yuan and the yen, then they could blow up the yen. They could manipulate that situation to their advantage, which would play into the gold market. Now they've got to a comfortable level, of having enough gold. They pull the trigger on the yen by way of the yuan. All of a sudden, we have a mess.
Yeah.
Because now, not only is the delusional paper market out of whack, there's no physical. It's not that there's no physical, it's that there's not enough to satisfy the demand. Because all of a sudden, if that delusional paper market gets out of balance, there's going to be a huge demand right at that moment. Now, all of a sudden, where's it going to come from?
Right. And that's the confidence game that you and I have discussed in the past, the just-in-time delivery that these bullion banks rely upon. And the fact that, oh, no, I've got gold. Sure. Yeah, no, these COMEX contracts, that's just as good as gold, right?
Right.
Or this unallocated account. Oh, they told me I can get it anytime I want. Right. It's when the confidence scheme fails, when somebody shows up and wants their unallocated gold and they're told, sorry, come back in 90 days. It's when the confidence scheme fails that this whole thing begins to unravel rather quickly. Again, it's anticipating that is the hard part. You mentioned the Chinese. Yeah, what if they did something that would drag down the yen, which would spike the dollar yen, which would crush paper gold prices? Well, maybe that's what they'd want to do, because they'd want to see if they could drive paper gold down to $800 and see how much they could get. Well, then that would really put the banks in a bind, you'd think, because they'd have to be supplying all this physical gold at $800, and I would say they probably don't want to do that. So, yeah, it's interesting to think of how all these parts connect. But the most important thing is that I would stress for everybody listening is, I mean, all these cats that are out there, the counting their waves and trying to make a living, and sell side analysts, trying to make a living off of, trying to tell you that this is important or this element of demand is important or whatever. Okay, that's all well and good, but I can assure you what really moves the price on a daily and intraday basis is Forex, and specifically the dollar yen. So if you can predict where that's going, and frankly, that looks in our favor at present, that's supportive of the paper price.
Eric Dubin put out a message on his Facebook page yesterday saying that this week looked pretty good, and so far that's what we've seen, and it appears that these guys are kind of terrified of the 1300 level. I mean, I know round numbers are a pretty big deal to begin with, but it seems like 1300 is something. There's something going on there in particular, because gold cannot seem to breach that line. I mean, what are your thoughts as far as just the very, very short term, the next week or 10 days or so? I mean, what are we looking at here?
I suppose on a psychological basis, again, those carbon-based traders that we were talking about see that and think that's important. But, if you wake up tomorrow morning and the dollar yen's down 2 points at 108 and change, we're going to be clear. We're going to sail through 1300 like a hot knife through butter, right?
Okay.
It doesn't matter. I mean, you're not going to see the dollar yen fall 2 points tomorrow and gold go flat because it doesn't want to go through. That's just not maybe 20 years ago, but the computers will just make it happen. And so, anyway, I'm not too concerned about that. More important to me is that the dollar index is in a clear down channel, put in its highs for the year couldn't get through a 103.5 back in late December and early January. And now King dollar's down maybe almost 7% year to date. And in a clear down channel, dollar yen, which is a reflection again of yen strength, dollar weakness, is also in a clear down channel. Now, it had broken out of that channel temporarily, but then it fell back in a couple of weeks ago, that day when all the impeachment talk was being bandied about, and it was down 2 points and gold was up $22. Imagine that. Now, it had bounced, the dollar yen specifically had bounced from the lower end of its channel and off of its 200-day moving average back in April. Well, that big move yesterday was important, not for a number of reasons, not the least of which was it absolutely blasted down through the 200-day moving average, and it's now about a full point below. So if it remains below the 200-day moving average, that should inspire more dollar yen selling, with the dollar index all the way down at the bottom of its range and almost back to the level where it was at the lows of election night. Well, if the dollar yen now is going to be below its 200-day, that means it could probably fall that far as well.
Wow.
That would be another, 5 or 6 points. So if we get another 5 or 6 points down the dollar yen, that would translate to another $60, $70 in gold, which would put us up close to last year's highs. So again, not to make it, well, hell, everybody thinks I'm out here trying to sell subscriptions and all this kind of stuff. I'm telling you all that you need to know. You don't need to buy a subscription to TFMR to understand this. Okay, just watch the dollar yen. I mean, if it looks to you like it's going to go to 105, then I think you can continue to trade and hold gold and all that kind of stuff. But that's really the key, and that's been the biggest development this week, is breaking down through the 200-day moving average. And now we'll just see through all the news tomorrow and into Friday whether we can stay there.
Well, all right. Well, in the future, when we have these conversations, I'm just going to ask you about the currency market and just the heck with gold. I mean, might as well.
Yeah. I mean, Rory, I mean, and in all seriousness, that's true for now.
Yeah.
I mean, it's important to keep track of, again, that underlying physical and things you hear through the wind, about, what demand is like and trends in Russia and China and all that kind of stuff. That's all. I don't want to say it's not important, because in the big picture, it's extremely important. But the idea that, we're going to sit here and either say, well, this is monsoon season, and so that's going to, or we're, look, if I count my waves, we're in wave B of subcycle X and all. No, we're going to try to assess where the dollar yen might be going, and then project from there how close we are to a bottom or a top. And what the trend is in paper gold. I mean, seriously, it's really all it is.
Last comment, and it's regarding the physical metal, both gold and silver. For the past probably decade, the miners have been in serious trouble as far as their inflows of capital, and they enjoyed a good run up for a short period. Now they've been beat back down. I mean, there's not enough capital inflow at this point to get these mines off of the ground. No pun intended, but I mean, they can't seem to get any legs. How are we going to be able to replenish these markets for the physical gold if we're not digging it out of the ground?
Yeah, that's all part of the conundrum too, isn't it? That the banks face. It'll be interesting to see where the miners go from here. And a lot of we got this GDXJ thing hanging out there another 10 days from now, and that has really put the kibosh on interest in the sector kind of institutionally for the last 6 weeks. And you can see it. I mean, there are days when the metals are moving fine, and the miners don't do anything. And if anything, it's just a flow of funds. I mean, you don't have everybody from institutions down to your local stockbroker recommending GDXJ or GDX anybody until we get through this thing. And so with that lack of buying interest, the shares have just been kind of languishing. But I've just been, look, let me put this back to the dollar, and then we'll try to connect these dots. I mean, I have thought, and I think we probably spoke about this the last time we talked. I mean, I call it the generally accepted narrative of 2017. And that is, back on election night, Trump was going to be the worst thing that could possibly ever happen. And as soon as he was elected, the Dow was down limit, or the Dow futures were down limit, S&P futures were down limit, the dollar index was crashing, all this kind of stuff. Yep. And then magically, the narrative changed, and it was going to be great. Yeah. And Trump was going to, he's going to deficit spend and infrastructure and tax cuts and interest rates are going to go up. And it's, this was easy. The dollar was going to get stronger. And I've contended since December that generally accepted narrative of how it was going to play out was wrong. The dollar wasn't going to go up. That interest rates weren't going to go up. All this Trump stuff wasn't going to happen. And that's clearly what has now played out for the first 6 months of this year.
Yep.
There is this notion, and you read this places about the Trump, I guess the Trumpflation trade is not happening. That's just another iteration of the same thing. This general understanding that narrative is falling apart is gradually taking hold, and you're seeing that in the gradual fall of the dollar yen and the gradual rise of gold prices. I think it's going to be fourth quarter before it's completely clear that this has failed, right?
Yep.
And so I've long maintained since the beginning of the year that the highs for the year in prices for the metals will be in the fourth quarter. I mean, that makes sense, right? Well, the same thing then could be said for the miners. We'll get through this period with the GDXJ. We'll get through, the sector being slightly out of favor and all that kind of stuff. Man, if I'm right, and gold's back to say $1,400 by the end of the year, and silver's up at 22. Well, the Hui's not going to be 200.
No.
And so everybody that trades these things, and they trade those damn ETFs, I mean, they all get bent out of shape on a daily basis. But I mean, if you think the prices are going higher, then you just got to try to pick the right ones that are the right miners that are capitalized, that are run by good people, and know what they're doing. Then you just got to wait. And if we're right about prices, then the shares will be higher, and how they were doing on June the 1st, will be insignificant.
Exactly. And patience, that's not really one of our things,
No.
We want it now.
Yeah, well, and I'm sure there are people listening going, yeah, well, I've held the miners and the metals for 5 years and all they've done is go down. That's not right. Fine. I'm talking about from here, this moment. And if you hold them from the rest of this year, if the prices are going higher, then the shares are going to go higher too. And that's what I would expect. And then I would expect, again, I expect that to continue into 18 as well. If, that's under the kind of the auspices of the system continuing as it is, which I expect it will. But then we just never know, what might happen though, on a large scale at any time.
Anything is possible. At any moment, this whole thing is so fragile that nothing at all would surprise me on any given day. And I mean that sincerely. Nothing. I mean, it's just insanity out there. But we've been speaking with Craig Hemke, who is the president and founder of Turdville, and you can find all of his great work over at tfmetalsreport.com.
I was actually, I'll just tell you what I was thinking earlier today. I was thinking about how it's now been almost 4 years ago that we took the site private, if you will, and that I could have kept it as a public site, and I probably have a lot of additional notoriety at this point, right?
Yep.
But we took it private. I mean, I just didn't want the site to become Zero Hedge or some of these other sites, that's populated with all kinds of crazy people, typing all kinds of crazy things. And I just didn't want that on my site. Plus, as a business model, to sit there and rely on ads, as many people have now figured out the way Google and YouTube are screwing people, that just doesn't fly. So we put up this paywall. It's $12 a month. I mean, 40 cents a day. It weeds out the trolls. It allows us to keep the conversation civil, right? Rather than everything being about, anti-Semitism and, that you read on Zero Hedge, and all through the internet. I don't mean to pick on Zero Hedge, but everywhere you go, the comment sections are just a disaster.
Yes.
But TFMR is not that way. And again, I think a lot of that is due to that little itty bitty paywall. People are civil. People are all out to help each other. We recognize we're all in the same boat. And if you want to play along, I mean, it's going to cost you a whopping 40 cents a day. tfmetalsreport.com. I think most people that are subscribers are pretty happy with it.
I would say.
Anyway, thank you, Rory. And
I
appreciate coming on, and I hope this was helpful for everybody.
Well, I'm sure that it will be, and I certainly appreciate all your time, Craig, and we will talk with you soon, my friend.
Okay, take all the best.